Whenever the stock market declines a little bit, YouTube is full of videos about potential stock market crashes. And of course, there are some numbers indicating that the stock market crash could happen very soon. Some people are terrified about the stock market crash, but it's also an opportunity to buy stocks at lower prices or decrease your cost average, also called DCA. So to be honest, I really like stock market crashes because it allows me to buy those awesome companies that are overvalued when the stock price declines. In the past couple of weeks I've been analyzing several stocks, and they all got my attention for a longer period of time. And right now it feels that these stocks are the best stocks to buy right now. In this video I'm going to show you a list of 4 stocks that I'm quickly analyzing and highlighting some pros and cons. It's not a deep dive, so keep this in mind. In the last part I'm going to check the price targets for each stock. I'm very excited to see what you guys think about these stocks, so please let me know your thoughts in the comments. And if you think a company is missing in this list, please let me know as well. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. First stock on this list is Visa. It's one of my favorite stocks and I do own shares of this stock right now. I've been covering this stock for several times and each time I'm still impressed by this company. Visa is the largest payment processor in the world. In fiscal 2021, it processed over 10 trillion purchase transactions. Visa operates over 200 countries and processes transactions in over 116 currencies. Its systems are capable of processing over 65,000 transactions per second. Visa has a 52-week high of $236 a share and a 52-week low of $187 a share. Right now, Visa is at $193 a share, which means almost at their 52-week low. Does this mean to buy this stock immediately? No, we need to analyze this stock first. Visa is a 317 billion market cap company, which makes them one of the larger companies in the US based on market cap. PE ratio is at 21, which could indicate it's around its fair value based on the PE ratio. The 5-year PE ratio is at 27, so this 21 looks quite good to me. PE ratio is decreasing since the stock price went down a lot. Earnings went up and Visa bought back a lot of shares, which we will cover in a minute. First, let's check the revenue growth. In this graph we see that revenue went up quite nice and steady. It only went down when the pandemic hit us, and right after that it went up again. So this comforts me a lot. 10 years ago Visa did 10 billion in revenue, and in the trailing 12 months Visa did 28 billion. Net income sits at 14.6 billion, which gives us a profit margin of 52%, which is slightly above the 5-year average, so margins are increasing. Next up is free cash flow, which is a very important metric to me, since this is used to pay down debt, buy back shares, do acquisitions, pay dividends and a lot of things. In this graph we see that free cash flow went up a lot in the past couple of years, and to be honest it's not really steady and consistent. So I do like to see a bit more consistent pattern here. But in the end it's going up, which is the good part. For me it's very important that big companies like Visa are buying back shares, since this will increase the EPS, makes it easier to sustain and increase dividends, and also the PE ratio will go down if the stock price stays the same. In the past 5 years Visa bought back 28% of the shares outstanding, which is more than a quarter. So I really like this number. But keep in mind that you want them to buy back undervalued shares. So with the PE ratio getting lower and lower, you want the shares outstanding decrease big time. Next up are the dividends. Right now dividend yield is at 0.77%, which is of course not that high. Visa pays you $1.5 annually per share or $0.38 per quarter. Payout ratio is at only 20%, which is really low. There's 80% left in cash to pay down debt, buy back shares, do acquisitions and a lot of things. To be honest, I would prefer a higher dividend yield and payout ratio sitting at 30 to 40%. But luckily for us, Visa is growing the dividends in high amounts. They have a 5-year growth rate of 17.8%, which is really high, and they grew the dividends for 13 years in a row. Another great thing about this company is the fact that they can pay down almost all the debt with the current cash position. Cash sits at 70 billion, while debt is at 23 billion, so I really like this number. The last part of this analysis about Visa is the price targets that I created using the Everything Money software, which is one of the better tools out there. We have to fill in a low, mid and high assumption to get the price targets, starting off with the revenue growth. I expect single to low double-digit growth numbers for Visa. It's still growing in high amounts, and with the booming e-commerce, I think revenue will increase at a decent pace. For the profit margin, I expect margins to be steady, at 50, 53 and 55%. Same story with the free cash flow margin. PE ratio is at 21 right now, and this seems fair to me. Visa has a moat in my opinion, and on top of that they are the biggest company in the industry. So I'm filling in 21, 22 and 23. Same story for the price to free cash flow. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. I hit analyze and we see some green numbers. We have a low price target of $156, a mid price target of $184, which is slightly below the current stock price, and we have a high price target of $213. So if you believe these high numbers, then Visa stock is a buy. To me, the high assumption seems justified, so I'm still bullish on this stock. But I wouldn't mind if the stock price continues to fall from here. So for now, I think I will just wait a little bit longer to see if I can enter at lower prices to increase my potential. Next stock on this list is Abbvie, ticker symbol Googl. And again, this is also one of my favorite stocks and already in my portfolio. Abbvie is a holding company. Internet media giant Google is a wholly owned subsidiary. Google generates 99% of Abbvie's revenue, of which more than 85% is from online ads. Google other revenue is from sales of apps and content on Google Play and YouTube, as well as cloud service fees and other licensing revenue. Google has a 52-week high of $151 and a 52-week low of $100. Right now, Google is at $102 a share, so it's around its 52-week low. But does this mean that Google stock is a buy right now? Let's find out by analyzing this company. Abbvie is a 1.35 trillion market cap company, which makes them one of the biggest companies in the world. PE ratio is at 18, which could indicate that they are undervalued. The 5-year PE ratio is at 31. In this graph we see that the revenue went up really nice and steady. During the lockdown periods, revenue went up even more. Trailing 12-month revenue is at 278 billion and net income is at 72 billion, which gives us a profit margin of 25.9%, which is higher than the 5-year average of 23%. And to be honest, I expect margins to increase even more. I'm a full-time advertiser and the CPC, cost per click, is increasing quite a lot lately. This means Google earns more money by getting the same amount of clicks within the ads. And since Google Ads represents around 85% of the total revenue, this will have a big impact of course. Next up is free cash flow, which is very important to me since this is used to pay down debt, buy back shares, do acquisitions, pay dividends and all other things. But since Google doesn't pay any dividends, all the money will be invested directly into the business. In this graph we see that free cash flow went up quite a lot in the past couple of years. But it's kinda the same story as with Visa. It's not really steady and consistent, but again it's going up in the long run, which is the most important here. In the past 5 years, Abbvie bought back roughly 5% of the shares outstanding, and I really like this a lot since Google seems undervalued and you want them to buy back undervalued shares. So I wouldn't mind if they buy back even more shares. Another thing that I really like about this company is the fact that cash is at 125 billion and debt is at only 28 billion, meaning they can pay down all the debt with a blink of an eye. So to me, this is really good. The last part of this analysis is about the price target. We have to fill in a low, mid and high assumption to get these price targets, starting off with revenue growth. For the revenue growth, I want to be a bit more conservative this time, even while the 10, 5 and 1 year numbers are really high. I fill in 7, 8 and 9%. For the profit margin, I fill in 23, 25 and 27%, since I expect that margins will increase even more. Free cash flow margin is the same story and I fill in 20, 22 and 24%. PE ratio is at 18 right now, and to me, Google is not the market leader, but they own the market basically. Their moat is one of the biggest out there, and I'm willing to pay a high PE ratio for this moat. So I'm filling in 20, 21 and 22. Same story for the price to free cash flow. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. I hit analyze and we see a lot of green numbers. We have a low price target of $83 to $95, a mid price target of $101 to $115, which is basically the current stock price for this stock, And we have a high price target of $123 to $138. And to me, the mid to high price target is the most justified here. I think Google will do great in the future, and revenue is still increasing. They have the biggest moat of all companies and are by far the biggest market leader in the industry. For now, I'm buying this stock every time whenever there's a dip to $100. Next stock on this list is Home Depot, and again, one of my favorite stocks that's already in my portfolio. Home Depot is the world's largest home improvement specialty retailer, operating more than 2,300 warehouse format stores in the United States, Canada and Mexico. Home Depot has a 52-week high of $420 and a 52-week low of $267, which is quite a big range. Right now, Home Depot is at $275, so it's almost at the 52-week low. Let's find out if HD stock is a buy right now. Home Depot is a $281 billion market cap company, which makes them one of the largest companies in the US. PE ratio is at 16 right now, which could indicate that they are undervalued. The 5-year PE ratio is at 21. In this graph we see that the revenue went up quite nice and steady over the past couple of years. During the lockdown periods, revenue of Home Depot went up quite a lot. Trailing 12-month revenue is at $155 billion and net income is at $16.8 billion, which gives us a profit margin of 10.9%, which is slightly above the 5-year average, so margins are increasing a tiny bit. A thing that I really like about Home Depot is the fact that they have one of the highest margins in this industry. Next up is free cash flow, which is very important to me since this is used to pay down debt, buy back shares, do acquisitions, pay dividends and all other things. In this graph we see that free cash flow went up really nice and steady, with a spike in 2020, which is related to the lockdown periods. To me, the free cash flow pattern looks really good, so I really like this free cash flow growth. One of the things that I do like the most about Home Depot is the fact that they buy back a lot of shares, which makes it easier to maintain and increase the dividends. On top of that, EPS will go up and PE ratio will go down. In the past 5 years, Home Depot bought back roughly 13.5% of the shares outstanding. Next up are the dividends. Right now, dividend yield is at 2.8%, which is pretty high. Annual payout is at $7.6 a share or $1.9 quarterly payment. Payout ratio is at 45%, meaning they have 55% left in cash to buy back shares, pay down debt and all other things. The 5-year growth rate is at 16.95%, so let's call it 70%. And this is of course really high and I do like this a lot. On top of that, they increased the dividends for 12 years in a row. A thing to keep your eye on is the debt to cash ratio. Right now, Home Depot has $13.8 billion in cash, while debt is at $47 billion. I prefer companies that can pay down a bigger chunk of their total debt, so definitely keep an eye on this number. The last part of this analysis is about the price target. We have to fill in a low, mid and high assumption to get the price targets for Home Depot, starting off with revenue growth. I'm a bit conservative this time and I expect lower revenue growth in the future, so I'm filling in 5, 6 and 7%. For the profit margin, I expect 10, 11 and 12%. Same story for the free cash flow margin, 8, 9 and 10%. PE ratio is at 60 and that looks like a fair valuation number for this company. So I'm filling in 16, 17 and 18, since Home Depot is a market leader and has one of the highest profit margins in this industry, so you might want to pay a higher multiple here. It's the same story with the price to free cash flow. For my annual return, I put in 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now, Home Depot is at $275. I hit analyze and we see some green numbers. We have a low price target of $181 to $227, a mid price target of $227 to $278, which is around the current stock price, and we have a high price target of $281 to $337. To me, the mid to high price target is the most justified here, and I'm leaning a bit more towards the high price target. Home Depot is a great company and right now it seems undervalued to me. I do like the stock both from a value point and a dividend point of investing, so I will increase my position very soon. Last stock on this list is Abbvie. I already own this stock and I think it's the stock that's been in the portfolio for the longest period of time versus the other ones in this list. It's also been covered quite a few times and I'm still bullish on the stock. Abbvie is a pharmaceutical company with a strong exposure to immunology and oncology. The firm's top drug Humira represents close to half of the company's current profits. Abbvie has a 52-week high of $175 a share and a 52-week low of $105. Right now it's at $144, so right in the middle. Abbvie is a $255 billion market cap company, which makes them one of the largest pharmaceutical companies in the US. PE ratio is at 20 right now, which could indicate that Abbvie is around its fair valuation. In this graph we see that revenue is growing at a steady and consistent pace, so I do like this a lot. During the lockdown periods, Abbvie's revenue skyrocketed, and after things cooled down, it went back to normal growth numbers again. Trailing 12-month revenue is at $57 billion and net income is at $12 billion, which gives us a profit margin of 22%, which is way higher than the 5-year average of 70.5%. So I do like this a lot. It means margins are increasing. Next up is free cash flow, which is very important to me since this is used to pay down debt, buy back shares, do acquisitions, pay dividends and a lot of things. Free cash flow has increased very steady and consistent in the past couple of years, so I do like this a lot. A thing that I don't like about this company are the shares outstanding. It's increasing, which isn't a good thing, so definitely keep an eye on this number in the future. One of the reasons why I don't like this number is because it will be harder to sustain and increase the dividends, because for each share they issue, total dividends paid will go up. Right now, dividend yield is at 3.96% and Abbvie pays you a $5.64 annually per share, or $1.41 each quarter. Payout ratio is at 41%, which is good to me. There's 59% left in cash to pay down debt, buy back shares, do acquisitions and a lot of things. The 5-year growth rate is something that I really like. It's at 17.5%, which is really high of course. On top of that, Abbvie increased the dividends for 8 years in a row. Another thing to keep your eye on is the total debt. Right now, debt is at $73 billion, while cash is around $20 billion. So this is something that I don't like, since I prefer companies who can pay down a big chunk of their total debt. The last part of this analysis is about the price target. We have to fill in a low, mid and high assumption to get the price targets for Abbvie. Starting off with revenue growth. I expect revenue to grow at high single digits, so I'm filling in 8, 9 and 10%. Profit margin I'm filling in 18, 21 and 24% since margins are increasing right now. It's the same story with the free cash flow margin. PE ratio is at 20 right now, but I do want to pay a lower multiple here since it will be harder to grow in high numbers in the future. So I'm filling in 15, 16 and 17. And it's the same story with the price to free cash flow. For my desired annual return, I'm filling in 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, Abbvie is at $144 a share. I hit analyze and we do see a lot of green numbers. We have a low price target of $104 to $174, a mid price target of $136 to $220, and a high price target of $173 to $275. To me, the mid price target range of $136 to $220 is the most justified here. So Abbvie is a very interesting stock, both from a value point of investing and a dividend point of investing. Right now, Abbvie is already in my portfolio and I'm planning to buy even more very soon. And this was the full list of stocks that I'm buying right now during this small dip in the stock market. All companies in this list are very interesting for different reasons, but they do have something in common. They seem undervalued to me. Most of them pay a decent dividend, which is something that I really like. For now, I'm focusing on these stocks and hopefully the stocks will go down even more so I can add more shares at lower prices. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.